Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Pederson.
Thank you for joining me today. This is the Real Estate Risk Report. I am your host, as always, Lance Pederson. So today I have with me Terrance Doyle. He is with the Value Add Real Estate Company. How you doing today, Terrance?
Fantastic. It's close to 70 degrees in Denver, and it was 20 degrees 2 days ago. So I'm feeling great.
No, that's amazing. Yeah, that's amazing. And the beauty of, even Denver, you get a lot of blue skies. And so to get like on a January day, 70 degrees, we got to wrap this podcast up as quickly as possible.
I need to get out and play some golf here.
Yeah, you're going to go play some golf.
The snow's melting.
That's right. That's good stuff. So why don't you share a little bit with us sort of how you got in, how'd you get into real estate, and kind of what led to, present day, like what led to the formation of the Value Add Real Estate Company?
Yeah, that's kind of a loaded question. I'll try and give you the cliff notes, but briefly, I was in college in Denver. I went to Colorado Christian University. I like to say that I was the white guy at the end of the bench that they paid me to go to school to keep the team GPA up. So I was the guy that, my GPA was high enough to help us clear the NCAA regulations. But I was fortunate enough to get a scholarship to play basketball. And in my junior year, two other teammates and I started a company called OxyFresh Carpet Cleaning. And that was my first experience in business. And I knew nothing about being an entrepreneur. I never even considered starting a business, much less a carpet cleaning company in college. But my two partners were senior to me. They had a little bit more experience in business. They had both been entrepreneurs previously and started different like fireworks shops and other things when they were younger with their parents. And that went pretty well. We ended up selling close to 180 franchise units in the first 2 years. This was 2006-07. And then in 2008, we had another tremendous year. So as the economy was kind of crashing from real estate, a lot of people that were being displaced from work were looking to own their own business and be operators. Mm-hmm. And being in the service industry, specifically carpet cleaning, was one of those that I guess we just hit at the right time. So I had made a couple dollars. One of my other college teammates came to me just at the end of 2008, end of 2007, beginning of 2008, and talked about buying foreclosures at a public trustee sale. And before that, at the time I was renting and I knew nothing about real estate, had never owned anything. My parents had never taught me about real estate. I came from just a really blue collar. My dad didn't go to college. My mom's an immigrant from South America. So I knew nothing about real estate, but it sounded interesting. I was kind of an opportunist. So I was like, well, that sounds amazing. Let's buy one. So I funded one of the first properties in 2008. We bought a house at the Denver public trustee sale for around $56,000. And maybe 6 weeks later, we sold it for $98,000 or something ridiculous. Yeah. And my mind was just blown. I was like, oh my gosh, this is insane. Like what just happened?
You're thinking of all those franchises and the carpets that had to be cleaned to make that kind of money.
That's right. We had done pretty well, but I was like, I'd never made $30,000, and I didn't obviously make all the money myself. I had two partners, but I was like, this is incredible. How do we do this again? So we ended up, so the light bulb kind of started to go off then in 2008, and we were able to secure one investor that was associated with our alma mater, Colorado Christian. And he gave us a line of credit for roughly $5 million to do this same strategy. And this was back, Today, $5 million doesn't seem like a lot just because there's so much liquidity in the market. But back then, $5 million when the economy was crashing, everyone thought the world was ending, especially in real estate. It was very hard to find $5 million. So that was like a huge pivotal moment. And we ended up averaging to do close to 100 flips a year. So from 2008 to 2014, my two partners and I, they were majority doing a lot of the work. I connected more on the capital side and more on the operator side. So once we had kind of maxed out what we could do in the Denver market, we looked to other markets to do the same strategy that may be a little bit behind Denver. So we did a few flips in Vegas, Indiana, Tampa, Florida. And, cumulatively that ended up being roughly 600 transactions. I still didn't understand real estate at that point. I just knew that if you found cash and you had a good operator on the ground that could identify and we could sell them quickly, and we could make some alpha there. And so then in 2014, we'd had a really good run. We had done a couple other ventures, and I was engaged. I had gotten engaged that year. And it's funny how, like a woman will change your whole life. And literally that's kind of what happened is, I got engaged and I started to think about having a family and what life would look like and having a real career. And so I decided to branch off on my own and start my own company. And I ended up quickly realizing that my mom was from South America, Bogota, Colombia. So I spoke fluent Spanish from a young age. And so I quickly realized that by using Spanish, I could get labor done faster and cheaper by getting these contractors to trust me. And they kind of felt like I was kind of a family member a little bit. Yeah. Like, here's this guy that's going to give us work. He's going to pay us on time. He speaks our language. And so that was really kind of the starting point for me that has led to where we are now. And so I ended up kind of stumbling upon multifamily. A friend of mine from church ended up selling me like 3 or 4 duplexes back in 2014, 15. And at the time, before that, I had never done anything in multifamily. All I knew was single family flips.
Yeah.
And going through that process of doing the same thing, like renovating kitchens, bathrooms, exterior windows, just like I would have single family flip. But the difference was when I was finished, I didn't sell it. I had to lease it up. And so I quickly learned about leasing. And one of the nuances of leasing that I learned that has really been the foundation of our business is that every $100 I was able to raise rent on that renovated unit was roughly worth $20,000 of value at a 6% cap rate.
Right.
So really fundamental. $100 equals 20,000 of back end. I could do that math. And I was like, okay, great. Now I need to go find as many buildings in core Denver that are under market rent that I can renovate and see what I can raise the rent to. Yep. And so that was really the ignition to that, or, the starting point. And since then I've executed that strategy. I started with duplexes and fourplexes and did, some 6 and 10 and 20. And then I started, my hometown was Des Moines, Iowa. So then I started to buy in Des Moines a little bit larger. My first large acquisition in Des Moines was a 40 unit. And then I went on to buy a couple 50 and 100 unit buildings. And so now, I own, with my brother and my family in Des Moines, we own and manage roughly 400 apartments. And in Denver, we have about 400 as well. In Denver, our strategy has been a little bit more, we buy it, we renovate, stabilize. And because the market has appreciated so much and there's so much liquidity here from out of state, we've been selling them inside of 36 months. So it hasn't been a long-term hold. Yeah. But in Des Moines, it's definitely more of a long-term strategy. We have a really low basis. We have the property management, and we're just looking to, quote unquote, click coupons every month and just, generate cash flow.
Yeah, no, I think that's great. Here sort of you executing in to those the differences of the markets, right? Like a Denver, an 18-hour city, and like you said, you just get it where it makes more sense to go ahead and reap the benefits, right? It's like appreciating, people are trying to get in. So, I mean, with, and then Des Moines on the other hand, I'm from Minot, North Dakota, which, is smaller than Des Moines, but sort of a similar cultural feel, I think, in terms of
very small, small town
you're not
feel.
Seeing a lot of volatility. I mean, people are, they're pretty conservatively oriented, and, so it's just steady Eddie.
That's right.
Make it happen. Yeah. Take care.
Very low unemployment. Same industries have been there. People, what's interesting is during the pandemic, to prove that point, during the pandemic, even though the rest of the country is really getting affected with a lot of unemployment, I mean, we collected 96% of rents since April, in Des Moines. I mean, there just was not a lot of, even though some people in the service industry and gyms might have been affected, we virtually, they were able to switch and, find another job. Just very blue collar, hardworking. Everybody works, very low unemployment, very, very steady and stable.
Yeah, it's like on paper, you wouldn't even know that they're, if you just all they had is the numbers and no dates, you probably wouldn't have hardly noticed
known that we were in a crisis.
Yeah, that's right. So, and it's funny, right? I mean, like, it makes a lot of sense is that with real estate is that it's sort of, you've got to, like, everyone has a similar trajectory, right? And it's interesting how you put it. I mean, you're willing to sort of admit, I think maybe others aren't, like, to say, hey man, I'd done like 600 transactions. I still didn't really understand real estate investing.
Oh yeah.
Right. Like,
right.
But I mean, that sort of foundation of just it's a lot of hustle. Obviously,
Right.
that's a ton of work, right? To sort of acquire and flip and all the transactions that kind of go into that. And then of course, yeah, the aha is like, man, the same amount of work on a duplex or whatever that nearly to buy 50 of these things at once. And then to your point, to take it even further, like $100 rent increase, if we can get someone to pay us $100 more for that unit than they do today, that's 20 grand in value. Right.
That's right.
So for you now, especially, obviously it was a tremendous opportunity, and you sort of rode the wave. It sounds like you guys got, into the real estate game sort of, after the opportunity started to reveal itself after during the last downturn, and now, but for you, now that we're, everyone crushed it leading up, and now we're kind of going down the other side. How have you changed your sort of investment philosophy? And maybe it is sort of, hey, I look at Des Moines this way, I look at Denver that way, but how are you looking at acquisitions today differently than you did, a year ago?
Yeah, it's really interesting. And I like that question, is that, you didn't have to be a good operator, a good underwriter, or really almost good at anything if you bought apartment buildings in Denver in 2014. All you had to do was like hold it. And 3 years later, you could have done nothing and you would have made an incredible return. And I think that as times change, obviously we've had a really difficult year. There's been a lot of unemployment, especially as you get into more dense cities on the West Coast. Unemployment is much more of a factor than the Midwest. So, we do look at underwriting differently. One of the things that has helped is that debt has gone down about 100 basis points. So that's made things, so even though cap rates maybe haven't compressed that much, debt has gone down.
Yeah.
But there's been several iterations, to the business, from going from single family, first just buying at the public trustee sale where there's no broker involved. And then in 2014, a lot of people were into wholesaling. A lot of people were trying to find distressed real estate. A lot of people were doing mailers, door knocking. There was a lot more investors at that time. Bigger Pockets was starting to blow up. More podcasts were coming out. The media was starting to get onto this idea that, hey, buying real estate, specifically a value add, and then to take it one step further, multifamily real estate. All these things were just beginning to get like very trendy.
Yeah.
So then that was an iteration there, going from buying at the auction to having to build relationships with key brokers or wholesalers in town that would then bring me opportunities. And then I had to make another iteration when I went from buying, like duplexes and fourplexes to trying to buy 20, 30, 40, 50 unit buildings.
Yeah.
I had to go out there and I was really focused on building relationships. That's just, I was kind of focused on my strengths. And one of my strengths is I can build trust very quickly with someone. I can sit down with someone, they can hear my story. I can get to the core of who they are, what they're good at, and figure out where the synergy is for us to work together. And so I did that same thing in 2017. I had to build relationships. I had to find the key guys in town that knew Denver and knew that mid-size apartment building that was, 20 to 50 units, and build rapport with them to the point that they trusted me enough to bring me an opportunity when it presented itself. So then how that's changed today is I've had to do the same thing. Now that we have more capital and we have a little bit more traction, now we're looking to buy 100+ unit buildings. So it's been the same kind of transition as I've had to go out there and build relationships with the key guys that operate in that under institutional space. So we're kind of playing in that $10 to $40 million space in Denver right now.
Yep.
And so those are different relationships than I've had previously, where it was kind of more under, I would call it 10 million.
Sure.
In that $4 to $10 million space, the last 3 years, we've absolutely, I'd say, dominated the market in Denver, where if there was an off-market deal, value add, I definitely saw it. So that was one change of how things have looked. And so as we look at 100+ unit buildings, obviously we're not going to be able to increase rents $300 or $400 the way we have on a 20 unit building. That's kind of been our average. If we can increase rents, 35% minimum, that's a deal that we definitely look at. I'm not really looking at the going in cap rate because I'm going to clear the building and I'm going to completely redo it and re-tenant it. So I'm more focused on what is the construction going to be and what is the back end rent going to be once construction's finished. And that's completely almost gone away, that strategy, when I'm looking at 100 unit buildings, because the capital just doesn't make sense if you're going to clear the entire thing. So our underwriting has changed in that we're going to have on-site management. So what is the current owner paying? What are what's our staff going to do, because we've brought property management in-house. So, we do leasing a little bit differently. We do maintenance a little bit differently. So how is our management going to compare with theirs? How's our leasing going to look versus theirs? And what do we think it's going to look like as we turn these units slower? What is that going to look like after we maybe add backsplash to the kitchen, for instance, or we add stainless steel appliances versus white, or maybe they have patios. We're looking at a deal right now that's 100 plus units, and we're going to dress up the patio a little bit to make it more of like an inviting for the resident there, so make it more of an appealing amenity. So, we underwrite that pretty intensely, right? We're walking all the buildings in the area and we're looking at, hey, which ones have patios and what are they getting versus the ones that don't? And, what are the ones that have backsplash and stainless versus the ones that don't have those finishes? And so, that takes time, so I just think we're having longer due diligence periods, and we're spending more time on the nuances of property management, the expenses, and then what we can lease those units for in relation to what we're spending on the upgrades. So all those things have been nuances, but one of my big things has been, how do you add a zero? If we figured out this strategy of how to take, 20 units and renovate them and turn them and create, a nice return for myself and my partners, how can we do that on 200 units? And so we're just kind of just growing and learning. And, the same way as when I went from buying single family houses to doing a fourplex. So you kind of have to crawl before you walk and walk before you can run. And so I just feel like I'm in that process and that journey of just figuring out how to take our same strategy of creatively being able to add construction and property management to increase the value of a building.
Yeah. Like you said, it's like it's a formula, right? Like you've got to figure out, and it can't, and a few things that you've hit on, I think are important. I mean, one is, right, like understanding that, especially like in multifamily, these are consumers ultimately, right? It's what does the consumer, that person who's looking to rent in a given area, right? That's the nuance. There's the subtleties, right? Because like what is their preference? Are they going to prefer this over that, right? And to your point, then you say, well, I was able to get in at this basis, and and if we can make it go from this to that, and we put that unit on the market, are they going to pick ours over that? And are they willing to pay a little bit more? Right. So down to that level, which is, it can't be overlooked. Like that, this is the sort of thing when you're talking to operators and those who are doing these deals, like when you pan out and squint, it all sounds like they're doing the same thing. But when you get down, the devil's in the details. Right. And it's usually the people who really appreciate those little subtleties and the nuances, where it makes a difference. And I think the other thing, that you kind of hit on, you could see that progression, right, is that the value of the vertical integration. It's another term, vertically integrated, and everyone says it, but I mean, when you pull it apart, okay, if you're going to be the value add real estate company, then that means that you intend on, driving, value creation, meaning that you're going to, it's going to be bumpier. It's not core. It's not just already there and it's all nice.
It's not sexy. There's nothing sexy about it.
Sexy about that. Yeah. So there's more moving parts. So being, abdicating that to some third-party manager who's, just going to take the, whatever they're going to get 4, 5, 6% of rents or whatever. And then they're going to look for other ways to make money off of, the other things. I mean, so making that, leap to having management. And then to your point on the construction, and then the fact that these are all relationships, right? Because when you become, it's easy to say, well, we're going to start a property management company. Well, that inherently means more humans, right? So it means you're going to have to people manage, right? You're going to have to get sort of alignment among people. This is the standards. Here's what we're doing. This is why it matters. Once again, we want people to pick our apartments versus the building across the street. And then with like the construction thing as an example, I mean, there's all sorts of activity, being able to bring in, people to execute, and add the value to the units. So like you said, I speak Spanish. There's a lot of people, Spanish speaking guys who, are in the construction trade. Right. And, frankly, they get to dictate a little bit as who am I going to decide to work for? Right. Right. I don't, there's a shortage of labor, right? There's a labor crunch in many markets. And so being able to get access to those guys and to do quality work. So it's relationships, and you use the word trust. I mean, those are the things that I'm passionate about too. Like, it's all about you building relationships. Yeah, it's real estate and it's fun. It's interesting to nerd out, but it's like those who are better at building relationships, garnering trust, developing those things, that's where the magic happens. Right. And so totally, you can speak to that, like on the construction side, because clearly if you're going to go as far as to call yourself the value add real estate company, you're doing a lot of construction, right? There's stuff going on.
Absolutely. No, yeah, you totally nailed it. I mean, it's a ton of hard work. I just felt like, I started out, Lance, and I don't know if I mentioned this, but I started out with my own capital. I made some money, and then we, turned it and had a high velocity during doing flips. And then I did the same thing with a partner. We were doing these duplexes, fourplexes, and these smaller multis. And it was always with our own money. Maybe we had some friends and family lend us money, but we had no LPs, so we didn't have audited financials. We just knew that if we put $1 in, we knew that a year later we got $3 back. Right. And we were like, this is great. Let's do it again. And then we put $3 in. The next year we'd have $9, and then we just built it and just bootstrapped it like that. And so the way I look at every opportunity is with that lens. I think that when I hear a lot of different syndicators or people doing real estate, it's easy for people to talk about how great an opportunity is, but it's so different when you're doing it with your own capital. You just take it that much more serious, And so that's one of the things that I've really taken pride in. And I really myself believe in, that if I'm going to do a project or I'm going to invest in something, it's got to be something that I'm willing to write a check for and that I really believe in, and I've done it before. And so, the reason why I built out the construction and built up the property management was because when I would hire third parties back in the day, we ended up going way over budget. We'd show up on job sites, no one would be there. We'd have all these change orders that we didn't, that we had never agreed on. And on the property management side, I mean, I remember when we had reached like 100 and some units in Des Moines. And I remember flying back and we had a third party manager. And for 100 units, I think we had collected $18,000 in rent. I mean, something ridiculously low. And I just remember being like, guys, this can never happen again. You know what I mean? Like, we have 100 units. Like, how is this possible? And he had reports and, we went through page by page. And what a common denominator was that I took away from it was, because it's not his property and his money, he could care less if he pays a plumber $400. Yeah. He could care less if he overpays for a water heater, or overpays for a roof, or leases to a tenant that gets evicted 3 months later. Our interest, what I learned early on was that construction and property management, if I'm the landlord, your interests are not aligned. Mm-hmm. And so what I've tried to do is to align interest. And so I've tried to find ways to align my interests with investors, with brokers, with, the guys, the subs that are doing the work, with the leasing agents, because the more that you can align interest, projects turn out better. The bottom line turns out better, and turns out better for everybody. And so that's been one of the things that, and I learned it by losing money, my own money. You know what I mean? I learned it by having those months where I'm like, oh my gosh, I have to write a $25,000 check to cover these mortgages because we only collected $18,000. I mean, that's extremely painful, And so the pain and those losses really reinforce this idea that if I want to be in this business and I really want to build something valuable for myself, my partners, and my family, then I better learn it really well. And I better build every single piece, so I'm not depending on anyone else to basically create wealth for me and my family, or just to create income for my family and I, And so that was really the driving force behind that. And I think that's, a great lesson for everyone out there, is that losing money is a great reinforcement of how to do things the right way, and it was kind of my education. And so even though when I've gone to sell properties, we've ended up making money just because the market's gone up, I've learned the nuances of those operations and what to do and what not to do, and how to structure agreements with subs, how to structure agreements with our property management and everyone inside of there, with maintenance and leasing and just rent collection, all those things. And I'm actually very, very passionate about the leasing side and the property management side, because I want to create communities that I would want to be a part of if I was single or newly married or in the stage of life with the properties that we have, And so that's kind of the mentality. And I try and have that trickle down all the way down to the guys that are doing the maintenance. Is this a place that you're going to want to live. Do the work as if you were going to live here. Let's do the maintenance, the change orders. Let's do the unit turns. Let's try and do every single thing as if we were going to live here, or your parents were going to live here, or your girlfriend, whoever it may be, that's going to motivate you to have excellence and take pride in your work. And I think those are some of the nuances that have really helped to separate us from maybe other companies in the market that are, trying to do the same thing.
Yeah, I agree. And I call it conviction, right? It's a conviction to its core. Obviously, the name of the game is to make money, right? I mean, like that's how it goes, but that can't be your reason for being, right? There's got to be a purpose. And I do think that it's often overlooked by many guys in the industry is that they don't have a purpose beyond that. And then they're also the guys who wonder why they're not able to gain access to capital when they need it, at those levels. And it's that, and for me, I feel like that's the thing is that you blend in, like it all looks the same, right? Mm-hmm. And that people ultimately it's an emotional buy. I mean, if you're trying to raise money from LPs or whatever, I mean, it's with anything. Mm-hmm. It's all the stuff that you've hit on is that. Even for me, like I'm not the most articulate guy, but I'm a passionate dude. Like, and I have conviction about what I care about, much like you do. Right. And I don't have to say anything. I don't have to say it the right way. I don't have to do any of that. People pick up on that stuff. Mm-hmm. And, when it's genuine, then people are like, hey man, if I had a choice of who I do business with or who I hang out with, who I spend time with, I'm going to spend time with people like that have conviction. And it's that simple. Relationship builders who have conviction about it. That's what it is. If you're going to be a multifamily operator, you are in the business of building communities, right? Because people live in your building, right? Yeah. Like you said. And that is, once again, we talk about risk mitigation. It's even if you didn't fully believe it, but you said it anyway and executed it, that is a risk mitigant. Mm-hmm. It's like, it is about you build a community, then people enjoy living there. And guess what? Your occupancy will go up.
That's right.
Well, even if you're more expensive. Why? Because then they're saying, you need to come live here too. I love living in this community. This is a great little place. Especially like the guys I see doing, the mobile home parks and stuff, which I think is even a trickier, it's got a lot of crazy asset dynamics that can work against you. It can be very lucrative, mm-hmm. but that dynamic is even more so is that like these places, like most of the tenants, many of them, when you buy the park, they've lived there for years.
Yeah, they have nowhere else to go. Yeah,
they have nowhere else to go. And this is their place. And you come in and you start, acting like you're king shit, and you're going to do this, that, and the other thing. They're like, I don't think so. You know what I mean? Mm-hmm. And they're going to work against you at every turn. Right. Yeah. And so it's, why do we bring these things up? Because as passive investors, it's okay. Shiny IRR. We're going to get returns. They're going to do whatever. Like, okay, that's, you can use that as sort of a filtering criteria potentially, right? But when you get into it, this is what people are talking about when they're saying, because I'm a firm believer, like sponsor first, then everything else, right? Like if you can't get to the point where you can say, I trust these guys, right? Trust is the transaction. Mm-hmm. I trust Terrance and his team. I trust Terrance in particular, specifically, right? Because he's a leader. He's a leader of his company. And if I can't get there with him, then certainly not going to, part with my money, but that's where it starts. Right. And so but it's these little things as to why you get up in the morning make a difference, because your ability to execute the strategy and the business plan goes way up because you actually care.
That's right. Yeah.
Right.
No, I totally agree.
I'll start a construction company. I'll start a multifamily. That's not that's hard work, man.
Yeah.
And it is your money, of course. So it makes it even easier. Like you don't, you want to be in control of that, but that's how you have to look at it.
No, 100%. Yeah. I feel like I created a vehicle and a platform that if I was a passive investor, that I would have a little bit more faith in because of the failures that I've had, throughout the years of building this, and so, and that's really where, I'm at. I want to invest in my own projects because I know, that I've had enough experiences. I've turned enough units. I've seen almost everything there is to see, when it comes to the construction side. I've had guys walk off, guys steal from me, issues with cities, municipalities, go through historic districts. I mean, we've had to jump through so many hurdles on so many projects on the construction side that there isn't much that we haven't seen. And the same thing on the property management side. We've dealt with so many issues with tenants, obviously pandemics, floods, fires, that I just feel like we've had the experience that there's most likely nothing that's going to come our way that we haven't already seen. And if it does, we've proven that we have the ability to solve the problem creatively and in an efficient manner. And so that's something that I'm really passionate about is I want to build something that's a vehicle that people can have that confidence in, just like I do. And that's why I, in a lot of deals am the biggest investor, because it's like, if I'm going to do it, I want to be able to stand behind it and know that it's going to be something that I believe in. So
Yeah, no,
I totally agree with everything you're saying. And that's kind of been part of the mentality that's led to where we're at.
Yeah. So for you looking ahead now, I mean, what, putting on your prognosticator's hat, what do you, how is this going to shake out? I mean, and maybe for you in particular, just looking at the markets that you're operating in, I mean, where do you think the opportunity is going to lie? I mean, I know where you guys kind of pointed, you pointed yourselves at some of these, maybe, bigger deals a little bit, but, having gone through, like I said, you were able to sort of front seat, look, the last time we went through this, right. And you guys kind of rode that wave. So
yeah,
what do you think's going to happen here? Is there going to be a lot of that distress that will eventually kind of shake out here, or what do you think?
I think maybe there could be some pain. It depends on how the government is going to handle forbearance here coming up in single family, because I know that there are a lot of people around the country that got really hurt by the pandemic and by not being able to work. And it's going to be interesting to see how the government looks at that. It's going to be interesting to see how the government looks at, owners of office buildings and retail buildings where businesses weren't able to operate, and then they had to push out payments. So I just don't know. And I don't think we have enough clarity on that, but I think that there could potentially be some pain in the office, retail, commercial space. I think that in multifamily, there just has been zero pain. I mean, I think that there has been pain in LA, New York, and some of these larger cities where some of the residents went on rent strikes and those kind of things. And I'm not sure, I think banks were just extending mortgage payments and tacking it on at the end. So I don't even know how much pain they experienced. But, generally speaking, in multifamily, there's such an undersupply of affordable housing in almost every market. And there's people that are always looking for places to live. I mean, I think in Denver, there were like 30,000 units short of the market demand.
Right.
I think even in Des Moines, Iowa, with, there's been a ton of migration. I think Des Moines has been one of the fastest growing cities in the Midwest the last 3 or 4 years. And there's an undersupply there, and you're talking about flat farmland, where they can just build unlimited and there's still an undersupply. So I think, housing specifically in multifamily, there's just not any pain because people need an affordable place to live.
Yeah.
And so workforce housing and apartment buildings and, single family rentals, there just has been no pain. It's actually been the opposite. There's been a massive appreciation and inflation of prices the last 8 to 10 months in Denver specifically, and in Des Moines, I think slightly, but Denver, I think there's only like 30 days of inventory available, for 4 units and under. So there's just that undersupply has caused an increased demand, right? Just simple economics.
Yeah, exactly.
And so prices have skyrocketed, and, rents have been stable the last year. We forecasted rents to be stagnant up through 2022. Mm-hmm. So we're not forecasting or proforming any increase in rents. I think that once we get through this, the vaccine rolls out, employment gets back to a stable level, I could see rents, as migration continues to happen in Denver, I could see rents coming back to, we were seeing 1% to 2%, rent increases annually. So I think that could continue as you get to 2023, but I just don't think there's going to be that much pain. There's also a ton of capital on the sideline. So many people, even if people lost their jobs because of unemployment, the checks that were getting written every month that were higher sometimes than what people were making. There's just, I think the punchline, Lance, is that there's a lot of liquidity. And even though there was a lot of negative things that happened to the market and a lot of negative data points, that the federal government has basically printed our way out of this to where there's been virtually no pain. It's actually been the opposite I've seen on the single family side, that prices have skyrocketed. You can't even, kind of similar to like 2016, 17, as far as Denver. So I don't see a lot of pain. But in saying that, there's always opportunity.
Yes.
And even though Denver's been one of the hottest markets the last 4 or 5 years in terms of multifamily on almost any chart, we've continued to be able to source opportunity through kind of what you talked about, just the fundamentals of relationship building, of being able to understand what the broker's looking for, what the seller's looking for, and be able to find that kind of perfect, space in the middle where a deal can get done. And I think that's kind of one of the things that I've been able to do consistently, is being able to create opportunity regardless of kind of the market cycle and how hot it is. So even though Denver's been extremely hot, we've still been able to, find the right opportunity. You and I touched on this before the show, is you still have to be patient. You have to have the fundamentals. You have to know what your criteria is. You have to be very disciplined in that and just be patient, but work aggressively and consistently while you're being patient,
Yep, that's right. Yeah. And
which is not a fun,
Yeah, exactly. It's not sexy,
fun.
Right? But it just is. And that's why I just, I think that it's much of the things we've touched on, in the last few minutes here. But it's ultimately those who've picked, their areas like Denver, Des Moines, like they got conviction and they've got the relationships. And if you're patient and you're disciplined, like I said, always be able to find opportunity. That where it can go wrong is that it's like you live here and you're trying to source deals like in the other end of the. Hey, maybe you can pull it off, but right. I'm just me. Like that scares the crap out of me.
Right. Yeah.
Right. Like it just that real estate is location, highly fragmented. Right. The guys who wake up, real estate's full of guys who are they're hustlers. Right. They're just grinders. They're just got grit. Right. And so that's. It's when they're waking up every day and got the ear to the ground and doing what they're doing, and you're sitting there in some, New York City and you're trying to buy, like, I don't get it, man. I just don't see how you could ever be competitive.
Right.
It's not to say you can't, it's just to say, as a passive investor, all these little things we've hit on are the markers that you're looking for when you're looking at people to place money with and to partner with. Right. And it's just because that's what it takes to, once again, mitigate the risk and to ensure the success of the business plan. You got to press into it, make sure that, that's just it. You get pro forma. If they're all of a sudden saying we're going to get 3-4%, straight line rent growth over the next 6 years, like, dude, that's nuts. Like, that's not going to happen.
That's right.
Right. If it does happen, great. That's,
but you just don't want to plan for it or count on it. You
don't want to count on that, So anyway, good stuff. So where can people find you, Terrance?
We have a new website rolling out. It's going to be www at the Vareco, the value add real estate company, just abbreviated.com. And then my Instagram at Terrance Doyle. I'm pretty active on Instagram and LinkedIn. And and then I also have a podcast coming out with Bigger Pockets, really specifically focused on multifamily. We're going to be going through the nuances of construction, property management, acquisition, that whole thing. And it's going to be called the Tribe of Multifamily Mentors, hosted by Bigger Pockets. So that'll be coming out. It'll be first on YouTube. It's probably going to roll out in March, but we're recording episodes right now. So I'm really excited about that. So, anyone that's interested in multifamily, obviously it's a passion of mine. Something that you mentioned, conviction. So something I really believe in, but if listeners are interested in that, they can check that out. But I'm on social media, or they can, visit our website.
Awesome. Cool. Well, thanks for your time, man. It's been great to get to know you, and I really enjoyed our time.
Yeah, Lance, likewise. I appreciate it, man. Thank you.
All right, man. Take care.